Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. Meta is undervalued. There's no other way to put it. It's almost like clockwork how a high quality stock, a company that, the market generally loves, as it continues to go down, there's more and more bearish takes that start to happen. There's more question marks around some of the things that the company is doing. Over the past couple of years, particularly with the big tech stocks, because, they're the most analyzed companies in the market, this has been a repeated theme, whether it would be Apple, whether it be Google, whether it's even Amazon. As the stock continues to slide, there's question marks whether the CEO should still have a job. There's question marks whether the capex that they're doing is worth it, whether they're falling behind in AI, whatever it is. There's always a negative sentiment and a negative bearish narrative that starts to unfold coincidentally as the stock price continues to fall. Ladies and gentlemen, Meta is no different than that. There are question marks particularly around capex and whether this capex is worth it. And so that's what I kind of hope to answer for you in this video. And in addition to that, how even if the capex goes wrong, which I don't think it will, it ultimately doesn't matter too much. And so more on that later. For starters, I'd like to give a quick thank you to Fiscal AI for sponsoring this video because it allows me to make charts like this. I think a lot of people are looking at Meta and they're looking at that roughly, I don't know what it is today, like a 26, 27 times price to earnings multiple and concluding, okay, the stock is down a lot. Maybe you even like the stock. Maybe the capex isn't too much of an issue for you, but you're looking at it and you're saying it's not cheap enough. You would be wrong because it's missing one very key important thing, and that's there's this line within the Meta income statement called the provision for income taxes. And so I'll show that to you in a second, but if we exclude that out, Meta actually trades at about 18 times, 19 times trailing earnings today. And so if we hop over to Fiscal AI, go to the income statement and scroll down to the provision for income taxes, you'll see that they roughly average, $2 billion, $3 billion over the long term. And then all of a sudden in Q3, we see this massive $19 billion provision for income taxes. And this is kind of part of the reason why I really dislike using the PE ratio is it's full of little landmines like this. That's how I would describe it. These are landmines that it can artificially make a company look cheaper than it is, or it can make it look a lot more expensive than it actually is. In the case of Google, which we won't dive into, it's not the scope of today's video, it makes it look artificially cheaper than it is. Google today at $290 per share trades a little bit closer to about 35 times price to earning. Meta, on the other hand, although every single source on the internet that you can find, whether it be Yahoo Finance or any other stock research platform, says that it trades at 27 times earnings. If you actually look at the real raw profits of the business, you strip out that one-time thing, which is something that we could do on Fiscal with custom metrics, you'll see that it actually trades a little bit closer to 18 times trailing earnings. This is why I'm such a large proponent of Fiscal AI. It's a form of investing back into yourself, the investor, and you can get a 2-week free trial, no card required, with the link in the description down below. So now that we've gotten that context out of the way, please keep that in mind as we kind of start to dissect all the different sort of question marks and the bear theses on the company, because I want you to keep in mind, this is a company trading at 18 times earnings. This is in the land of retailers and apparel brands and so on and so forth, right? So let's attack this at the head of the spear with the main negative bear thesis, sentiment, everything like that, the AI Capex. And more importantly, I think there's a big question mark, and rightfully so, of people thinking that the AI Capex is not worth it for Meta. At the end of the day, if we look across the board, the other companies that are spending tens of billions of dollars on Capex, whether it be Amazon, Microsoft, or Google, all three of those, and actually Oracle as well, all four of those have a public cloud. They can immediately and directly start monetizing all of that Capex almost right away because they have a public cloud and they're able to use those GPUs in their public cloud to generate revenues. For Meta, it's a little bit more ambiguous. The only sort of way that Meta can actually start to monetize it is they improve their AI algorithm that is for like targeting videos for their users. Google also has this moat. I think Amazon to a lesser extent can also sort of increase the targeting of the search inside of the Amazon e-commerce app, but for Meta, it's exclusive to their apps. And so what we need to look for in terms of return on investment for the AI Capex is to look for better targeting of videos. Now, thankfully, the management is not stupid, so they directly give us a couple of clues into how this is starting to look within the apps. Again, going over to Fiscal AI, we have the investor relations and the transcript available to us here. And this is a direct quote from the transcript, directly from Mark Zuckerberg himself. He says, across Facebook, Instagram, and Threads, our AI recommendation systems are delivering higher quality and more relevant content, which led to 5% more time spent on Facebook, 10% more on Threads, and video in particular is a bright spot, with video time spent on Instagram being up more than 30% since last year. Some of this is, of course, organic. Somebody who downloads Facebook in year 1 compared to year 2, they spend a little bit more time on Facebook. But I would argue a significant portion of that extra time spent is because the average Instagram user is using Reels or they're using Facebook, whatever the case is, and they're having a great time. The algorithm and the videos are catered directly to their personality, their interests, which is resulting in them spending more time scrolling on Facebook or Instagram or whatever the case is. Now, of course, there's some, social ethics of social media taking over how much time we spend with family and friends and so on and so forth. As shareholders, this shouldn't matter to us. The point is, them spending all this money on training their own LLM and improving the AI algorithm is resulting in direct increase in time spent. And of course, time spent on the application is very important, because if somebody spends 10% more time on Facebook or Instagram or whatever, that means they're seeing more ads. If they see more ads, that's directly more revenues. And in fact, if we look at the quarterly growth of revenues, you'll see in the most recent quarter, it actually ticked up. It went back up to 26%. And this is in a scenario of, as you can see in 2022, the comparables, the lapping quarters were very weak. So it kind of created a discrepancy there. These are very strong comparables in the year 2024 that Meta is currently lapping, and they're still coming above those previous growth rates. They're coming in at 26% revenue growth. This is a company that is, I think, closing in on $200 billion of revenue, and they're growing this fast. And then to, add insult to injury, another point which you see echoed by Amazon, all the big cloud players that are dumping billions of dollars into CapEx, the management thinks they're under-investing. This is a real thing. Amazon said this, Google said this, they've said this for multiple quarters in a row. Meta said the same thing again this quarter. They said, I think it's pretty early, but I think we're seeing the returns in the core business. That's giving us a lot of confidence that we should be investing a lot more. And we want to make sure that we're not under-investing. That's how they frame it. They're seeing massive returns in terms of the AI algorithm being better at targeting both, advertising and the content that's served to you. They think they're under-investing. Another quote, this one compares something that was said by the Amazon CEO with the Meta CEO. Again, they said the same thing. I think that suggests that being able to make a significantly larger investment here is likely to be a profitable thing. And there's an argument online, which is partially a lazy argument of who are you to think that, you're a better steward of capital than the executive suite of these multi-trillion-dollar companies. I kind of agree with that, but it's not just like a abstract sort of up in the air statement that they're saying we should be investing more. You are seeing it within the numbers. There's serious returns to be had with all incremental spend into better infrastructure, more targeted ads, improving that algorithm. So the whole point of this CapEx question mark around the stock, and that has kind of dropped the stock by 25%. I just don't buy into it. I just don't think it's a serious issue. There was another quote from the transcript where they said, even if they overinvest, they could end up using it for their internal uses and so on and so forth. And maybe I'm wrong here. Maybe they do overinvest and it costs the shareholder massively. But over the long term, this shouldn't really matter too much. They're going to be using this spend in the long term anyways. Even if they do overinvest in the short term, it shouldn't matter too much. We saw something similar with Amazon e-commerce specifically, so a bit different of a proxy, where they overinvested in 2021 and 2022, and they kind of grew into that. The only scenario where this kind of goes wrong, in my opinion, is if the business ends up declining. And so in that scenario, then they wouldn't actually need all this extra infrastructure, but I doubt that happens. So point number one, I would just say the CapEx issue is a non-factor to me personally. I think it's just a fun little thing that you can dangle as a bear thesis on Meta. The bigger issue that I have with Meta is the predictability of the growth in the future. Now, you might say, Arya, you just finished talking about how they're growing 27%, 26% year over year. The CapEx is an incredible return on investment, so on and so forth. And I did just say that, but now we need to look at where the growth is coming from. And so I have another quote in here where they talk about Reels having an annual run rate of about $50 billion. And this is up from about $10 billion halfway through 2023. So if we jump back over to fiscal, you'll notice something very interesting. If we toggle on the total revenues of the business from Q2 2023, they were at about $120 billion of revenue, and they've grown to 190. So this $70 billion jump between this quarter here and this quarter here, about $40 billion of that, and it is run rate, so it's not exactly one-to-one, but we could say about half or maybe a little more than half of the growth here was directly a result of Instagram Reels. And so that, in my opinion, is a bigger question mark surrounding Meta as a whole, is where will your incremental growth come from? Over the next 2, 3, 4 years, will Instagram Reels be just as strong as it's been over the past 2 years? At the moment, Instagram Reels is growing 30% per year, but what will that look like over the next 5? And so at this point in the video, I'd like to point to something that I think among all the big tech companies, Meta probably does it best, or I should say Meta probably does it better than all the other big tech companies. And that's their ability to monetize seemingly unmonetizable assets, or in some capacity, spin up a new app or a new feature, something like that, and be able to monetize that new feature. Clear examples of this over the past 5 years is in fact the Instagram Reels asset. But even prior to that, when Snapchat took over the world and launched stories, Instagram just integrated stories inside of Instagram, and right away started monetizing it. They had a bigger number of users. They also already have a lot more advertisers compared to Snapchat. And basically right away, they started generating tons and tons of revenues as a result of essentially just copying this feature. I think more than Amazon, more than maybe not Google, but more than most of big tech, I think they had this ability to just kind of copy other features or spin up new business lines seemingly out of nowhere. And so while I am optimistic that Instagram Reels can continue to grow, as better targeting and so on and so forth, there is ultimately the question mark of 5 years out, what does that look like? And ultimately, I don't think it matters too much. I think they'll monetize Instagram Reels as much as they can, but they have a lot more assets to continue to monetize if the growth of that starts to slow down. And another asset that they have started to monetize, we're in sort of the early innings of it. It's funny to say because, they acquired it, I think, close to 15 years ago, but we're in the early innings of WhatsApp monetization. Now, to the North American viewer, such as myself, we don't really use WhatsApp. We use iMessage primarily, or just the normal texting app to text each other. But I mean, you can ask your international friends. Basically anywhere in the world not named North America, they use WhatsApp. In fact, they have 3 billion with a B monthly active users. I think we're coming up on the total number of people that have access to an internet connection in terms of how massive WhatsApp is globally. And this is a business that at the moment only generates $15 billion of revenue. And I say only because I think WhatsApp as a standalone business over the next 5 to 10 years could potentially turn into a $100 billion revenue business, if not more. The potential here is truly incredible. And here we have sort of like a breakdown of how they generate. There's about $10 billion of revenue from the business API. We'll come back to that in a second. There's about $4 billion of click to WhatsApp ads. And then there's $1.2 billion of in-app shopping. Now, what you'll start to notice with this is there's about a third of the revenues here from shopping. And so I actually had to Google this, but this click to WhatsApp ad is essentially like a button that you could put inside of your Instagram page or inside of your website or whatever. And then you can go over to WhatsApp and sort of have a direct line of communication with the brand, with their business account, and then be able to buy that product, whatever the case is. Now, again, to us North Americans, this is a bit of like an abstract concept. Why would you ever use that? Just go on Amazon, whatever the case is. But this is a real world thing, particularly, in Europe and South America, Asia, whatever the case is. People want to have that direct line of communication with the brand, go over to the business account, and it's generating massive amounts of revenues. And what I find most fascinating about this is this actually reminds me of OpenTable. OpenTable is, of course, the app that people use to make reservations for a restaurant, and the business model here is very similar to OpenTable. For WhatsApp Business, you pay a flat monthly fee, which starts at about $15 per month, or for the Business Plus plan, it's $45 per month. Then with the Business API, on a per message basis, you pay a small amount of money for each message to be able to send it to those recipients. It's almost like a marketing tool. It's almost like you subscribe to a newsletter, and with newsletter websites, they charge you per email sent or whatever the case is, or for 1,000 emails to be sent, in this case for 1,000 messages to be sent, they'll charge you like $1, whatever the case is. And then I would assume eventually they can also throw in another thing in here of each sale made through WhatsApp, Meta keeps like 3% or something like that. So you're seeing like a blend of sort of shopping and newsletter marketing communications. It's all kind of being weaved into WhatsApp Business. And I don't think the plan was ever to charge the user or put ads inside of WhatsApp. That's another opportunity. They can put just like, let me show you. This is something that Snapchat has done. Essentially, one of the chats is like an ad to, Ulta Beauty, whatever the case is, Sephora. So this is something that WhatsApp can also emulate and copy, but they haven't at the moment. This is, again, another sort of under-monetized feature that maybe they could pull on in the future. But even as it is today, this is the business model of WhatsApp. And I think it can turn out to be massive as it starts to get more adoption over time, particularly around the world. There's a lot of room for businesses to make a business account on WhatsApp and essentially open up a direct line of communication with their potential customers. And then as a result of that, Meta gets more advertising revenues, gets a monthly standard subscription revenue, and in addition to that, earns commissions on each sale made. So ultimately, the point I'm trying to make with this is we could sit here and try to do different projections and this and that about where the growth of Reels will be in the future. The point is the base level business, Instagram, Facebook, under Instagram, Reels, these things will grow at like a stable, at least call it 10% over the next however many years. But then you have all these different levers of monetization that Meta can pull on to bring on incremental growth. Another asset that we just didn't even discuss altogether is Instagram Threads. Is it called Instagram Threads? Threads, the Twitter copycat. As of August 2025, this was just a couple months ago, they had 400 million monthly active users. And so what you're seeing with this is Instagram Reels is a good growth engine for a number of years from now. Then you can start to bring on that WhatsApp monetization as they have. And Threads at the moment is generating $0 of revenue for them. You can imagine eventually as this reaches, a couple billion users, kind of funny that we're talking about a couple billion as if it's some small number we just kind of throw around. But as they achieve a couple billion users, almost certainly I would imagine they figure something out. That's kind of the point I'm trying to make with this. This company is brilliant. They just figure it out. They let it reach scale, they let it reach a lot of different users, and then they figure out the monetization portion later on, integrate some sort of ads, make a business use case for it, such as WhatsApp. And so ultimately, even I would say my gripe with the company, the question marks around future growth, that's ultimately a non-factor in the long term as well. And so when we jump over to making projections about the future of the business, I think the business is without a doubt undervalued, has the potential to outperform massively. I've put in some very, very bearish assumptions here. I'm saying over the next 5 years, the revenue grows at about 13%. I don't think this is a particularly difficult hurdle for them to achieve. Again, currently it's growing 26%. So this is a literal halving in terms of the compound annual growth rate of revenues over the next 5 years. We're saying margins don't improve, which is, again, a generally bearish sort of assumption to bake in here, because I think, 5 years out, we could probably be knocking on the door of 50% operating margins. But anyways, we'll keep it flat. And then I'm also saying there's a 3% buyback plus dividend, which at the moment, it's roughly about there. And so what you end up here with is assuming these numbers here over the next 5 years, and the multiple stays flat at the current 17 times EV to EBIT, or, you could swap in PE here. It wouldn't change anything. Without the multiple moving, you still end up with a 17% compound annual growth rate. This is, in my opinion, very bearish. This is if a lot of things go wrong. If the multiple doesn't move, you still end up with a wonderful return in the stock. I think a more realistic scenario, perhaps a little bit more bullish, is we get something like 15% revenue growth. We also see a decent amount of margin expansion. I'm not going to say too much. I'll say something like 47%. I think if you look at Morningstar, they're saying something north of 50%. But again, I'm not going to bake that in. And then if we look at the EV to EBIT multiple, you'll see that they've averaged about a 21, 22 times EV to EBIT over the long term. So that would roughly be this scenario here. If we do a little bit more revenue growth, more margin expansion, you're looking at a $2,000 stock 5 years out. That is a 27% per year compound annual growth rate. Now, I'm not saying this is like, the holy grail of valuation and the stock will reach that amount 5 years out. This is just to kind of give you a range of possibilities with what can happen with this business over the next 5 years. And if they somehow come above these assumptions, which is very possible, as we mentioned, they have a lot of levers of monetization to keep that close to 20%, above 20% growth rate. You're looking at a business that is going to massively outperform all of the assumptions that we're baking into the spreadsheet. And so there you have it. In summary, we have a business that, in my opinion, is wrongfully down on CapEx issues. Now, of course, that doesn't mean that the stock can't go down further from this point. This is a business that has historically been cyclical. It's had down years. In fact, there was a sell-off a couple years ago. You might have remembered it was down, give or take 70%. So bad things can happen for the business. But over the long term, ultimately, I don't think it matters too much. Ultimately, I think the revenue growth will continue at a solid pace, and that should result in solid shareholder returns in the future. Now, the one thing, am I personally going to be buying at the moment? No, but it's definitely towards the top of the watch list. What I want to do is build out my Adobe and Uber position a little bit more, particularly Adobe, as I've done extensive videos talking about how that company is stupidly undervalued. And so these two kind of take priority. I've done a lot more research into these two businesses. I'm a lot more comfortable and in tune with the numbers and what management has said and so on and so forth. Meta, in terms of priority list, is a little bit lower, but I do still think this is like a home run investment. It can outperform massively. Again, caveat, doesn't mean the stock can't go down further from this point. With that being said, thank you very much for watching. If you're interested to learn a little bit more about Meta, I actually recently did an exclusive on Meta over on my Discord, which you can join for the price of a coffee. Not only did I do, revenue projections and so on and so forth, but I also talked a little bit more about the cyclicality of the business. As I mentioned, this company has historically been very cyclical. And so we kind of dove a little bit more into that side of the equation. Link for that is also in the description if you're interested in checking that analysis out. Thank you very much for watching and have a great day.